Is China's property crisis about to trigger ripple effects across global markets? Chinese real estate giant Evergrande has been ordered to liquidate after failing to resolve its debt woes. The Hong Kong court's decision comes after 2 years of on and off negotiations. And Evergrande's overseas creditors now face major uncertainties about potential recoveries. Evergrande's collapse has been central to China's property slowdown, fueling broader economic anxiety and raising questions about the country's banking sector and global commodity demand. While direct international exposure is limited, global financial markets are watching closely for secondary effects, particularly on construction material prices and sentiment toward China's economy. In the near term, watch for increased volatility in emerging market currencies and commodities tied to China's property sector, as well as further government responses meant to contain potential financial contagion. Let's move to our second story. U.S. job growth shows signs of cooling. The latest employment report revealed that non-farm payrolls in the U.S. increased by 187,000 last month, slightly below analyst expectations. Unemployment edged up to 3.8%, its highest level since February 2022. The labor market is still resilient, with wage growth moderating and participation rates rising, but several sectors, including professional services and retail, are showing slower hiring. Why does this matter? The Federal Reserve is weighing future rate moves, and softer employment growth could reinforce a more dovish stance. Investors are dissecting labor data for clues on the central bank's next steps, as persistently high rates could impact everything from equities to mortgages and corporate credit. Looking forward, all eyes are on inflation data and Fed communications, as any signal of changing policy direction could reprice risk assets across financial markets. Our final headline today: Europe's natural gas prices remain volatile on geopolitical risks. Following pipeline outages and renewed concerns about supply from Russia, benchmark European gas prices jumped more than 12% this week. While storage levels across the EU remain above average for this time of year, unplanned outages and geopolitical tensions continue to drive sharp price movements. The energy crunch of 2022 may have eased, but new risks, such as strikes at key import facilities and reduced LNG flows, have kept prices sensitive to disruptions. For industry and households, this volatility feeds into broader inflationary pressures and complicates monetary policy for the European Central Bank. The potential for further supply shocks makes energy prices a crucial metric to watch, especially as Europe heads into colder months and prepares contingency plans. Stepping back, these developments underscore how interconnected global markets remain. China's real estate struggles, shifting U.S. labor dynamics, and European energy volatility all have cross-border effects investors cannot ignore. As always, ongoing policy responses and data releases will set the tone for asset prices in the weeks ahead. Investors should closely monitor Asia's credit markets, U.S. inflation readings, and European energy indicators for early signs of shifting trends. Drop your thoughts in the comments. And if you enjoyed the video, give it a thumbs up. Don't forget to subscribe and hit the bell icon. Thanks for watching. See you next time. This is not financial advice.